short of international finance, the basics. Okay, let me just, how do I log this? If I'm not wrong, it should be this. Okay, yeah, let's start. International finance, the basics. The first thing is a direct quote. What do you mean by direct quote? Direct quote means एक फॉरेन करेंसी देके मैं कितने रुपए कन्वर्ट कर सकता हूँ. That's the direct quote. So it means that for $1 how many INRs? That is the direct quote. If I say 1 USD is equals to 80 INR, that's the direct quote. But if I say the opposite, that 1 INR equals to 1 by 80 USDs, then it's the indirect quote. So foreign currency में INR को quote करना is direct quote. That is the convention in all formulas used. Indirect quote is the exception. That is the opposite. The two-way quote, how to interpret the two-way quote? It's the bid ask quote or the bid sell code or the bid offer code or whatever you want to call it. What do you mean by bid? The bank is willing to buy the foreign currency at that rate. What do you mean by foreign currency? I should not call it the foreign currency, I should call it the denominator. The bank is willing to buy the denominator at that rate of numerator. And the bank, what is the ask rate or the offer rate or the sell rate? The bank is willing to sell the denominator currency at that rate in numerator. But we are the customers. What do we interpret? The bid rate means if I sell my dollars, I will get 80 rupees. But if I want to buy a dollar, I would have to pay 82 rupees. So the basic idea is the bank always wins. That's how you think about the two-way code. Okay, American code and European code, that is just all problems. But there is an exception. The exception is if if the quote is given as follows. Let me grab my pencil and just tell you. If the quote is given as follows, dollar per GBP is usually 1.25, let's say. But if the ICI gives in question that GBP per dollar is given to be 1.25, how do you interpret it? You interpret that this was to be written and this is wrongly written. So they are just creating nuisance for us. Always there is a stronger currency and weaker currency concept, and global British pound is a stronger currency than dollar. Okay. Then cross rates. Cross rates you need to think from bottom up. We'll skip to directly the bid ask cross rates. So let's say you have a rupee to a dollar, that's 80 to 82, and dollar to euro, that's 1.25 to 1.35. What do you interpret? You want to get to, let's say, a rupee to a euro. So what do? You start with 1 euro. You have 1 euro. You have 1 euro and you want to get dollars from it. How much dollars would you get? You get the bid rate. So you get $1.25. Then what? You get $1.25. You convert these dollars into rupees. What do you get? You get 80 rupees per dollar. So you get 1.25 times 80, that is 100 rupees for such things. So you get, if you have 1 euro, if you have 1 euro, you get 100 INR. That is the bid rate. And similar for the ask rate. What do you want to know? If I want to buy a euro, how much rupees would I have to spend? So let's just say you want to buy a euro, you need 1.35 dollars, $1.35, and for that $1.35 you need to spend 82 per dollar. So 82 times 1.35, you get 110.7. That's the basic idea. Okay, let me clean this up. All right. Now, forward rates. If the forward rates are given in percentages or basis point. So first of all, what do you mean by forward rate? It's the rate in the future date. Okay. So what could happen? Either your currency could appreciate or depreciate. What do you mean by appreciation? The purchasing power of the currency increases. What do you mean by depreciation? The purchasing power of the currency decreases. Think from first principles again. I like to think from first principles. So let's think about the first principles. Let's say you have 1 USD equals to 80 INR, and this is always in the direct quotes, so you assume that everything works in direct quotes. Okay, and I have to note it here, it's direct quotes. Okay, and remember, direct quote means the foreign currency is in the denominator. Okay, so 1 USD equals to INR. I say that the USD appreciates by 5%. Okay, what do you mean by that? By the same dollar, by the same $1, I am able to buy 5% more of INR. What is 5% more of INR? 1 USD is equals to 80 times 1 plus 5%. That is the appreciation of USD. Okay, that's 84. And that's what I have written here. If the foreign currency appreciates or depreciate, multiply the value of home currency by 1 plus X percentage. Okay, that is the idea. Now, if I do the opposite, let's read the opposite and then we'll come back to the same. The home currency is appreciating or depreciating. You divide the home currency by 1 plus X percentage. So what you are doing is dividing. But what can we interpret it as? Dividing means you are multiplying the foreign currency by the same rate. And to do the same, let's say you have 1 USD equals to 80. Now we say the INR is depreciating by 5% down. Okay. What do? You either do 80 times 1 by 105. Sorry, 1 by 105. Okay. Is depreciating by this. Sorry, not when it's depreciating, you deduct it. Okay. 1 minus 5%. It's 1 USD. Or what we can do is 1 times 1.05 equals to divide by 80, and that's 1 INR per USD per dollar. That's again something you can earn per 1 INR per dollar. Basically, this will yield a different answer. This will yield a different answer, but the intuition remains the same. You can write a note. It could be added, it could be subtracted, but ICI follows these rules, so it's better to use the rules. Okay, so the idea is in a direct quote, if the foreign currency is appreciating, depreciating, you multiply the home currency by the following. And if it's the home currency which is appreciating, depreciating, you divide it. That's what you do. Okay. Remember that the appreciation of a home currency does not mean depreciation of the foreign currency and vice versa. Okay. Swap points. What is a swap point? Swap point means that you have been given a few points uh, for both for bid and ask, and there is a spread between the two. What do you mean by spread? Remember that the spread is the difference between the ask rate and the ask rate and the bid rate. That's the spread. And if the spread is positive, what do you interpret it? If the spread is positive in a swap point, then you expect the foreign currency to appreciate and the home currency to depreciate, and vice versa for the opposite. If the spread between the swap points is negative, you expect the foreign currency to depreciate and the home currency to appreciate. And therefore, when there is a appreciation expected in the foreign currency, you add to the spot rate, and when there is a depreciation in the foreign currency expected, you deduct to the spot rate. That's what you do with the swap points. An example has been given. If you want to try, you can try. Now, next is the forward premiums. If they are given as when the forward rate is given, forward premium when the forward rate is given. What is a premium? The premium means the following. Again, if the foreign currency is expected to appreciate, it is said to be premium. Then the forward rate would increase in the future, hence it's a premium. And the forward rate is more than the spot rate, which means the forward rate by spot rate is greater than 1. That means it's a premium. That is how you interpret it. In an indirect quote, these things will get reversed, and for the premium to become a discount, the forward rate has to be lower than the spot rate, which is interpreted as follows: that the foreign currency is expected to depreciate and the home currency is expected to appreciate. These are the first principles. All right. When it's given in swap points, I have told you the same. When it's a positive spread, you add it, and therefore it becomes the premium. When the spread is negative, you deduct it, it becomes a discount. And the opposite for the indirect quotes. All right. How do you calculate the rate of appreciation or depreciation, or rather call it premium or discount? You do it by follows. You do forward minus spot divided by spot times 100. That would give you the percentage of discount premium. You multiply it by the scaling factor. What is the scaling factor? The time factor. You would have 12 months divided by the number of difference between the spot and the forward and whatever. So you get the annualized discount or premium rate, or rather to call it discount means depreciation and premium means appreciation rate for direct quotes. For indirect quotes, you just reverse the formula or you just reverse the quotes and do the same. Not an issue. The logic behind this is the same. I've told you the same. Forwards divided by spot should be greater than 1, and therefore the percentage premium is forward divided by spot minus 1 to get the decimal times hundreds to get the percentages times the annualizing factor. All right. Next is the interest rate parity theory. The interest rate parity theory means that the spot rate times the interest rate in the numerator currency divided by the interest rate in the denominator currency would give you an expected spot rate that will be a great estimation for the forwards. Similar goes for the purchasing parity theory. It says that the law of one price should prevail. If the price of a keyboard in a certain country is same as this price of keyboard in the other country, then you can get a spot rate. And therefore, if the general inflation principle apply, then the forex should move in line with the inflation, and therefore the spot rate times the inflation differential will give you the expected spot rate in the future, which is a close estimate to the forward. The international Fisher effects gives you the simple equation of the first, that the nominal interest rate is the outcome of the compounding effect of the real interest rate times the inflation. And what the international Fisher effect puts as its objective is to prove that the real interest rates remain the same, and therefore the nominal interest rates and the inflation rates, the differential of both should give you the same thing, because the nominals have just been multiplied by real interest rates divided by real interest rate, therefore they cancel out. So the nominal interest rate differential, that is the home currency nominal rate divided by the nominal rate in the foreign currency, is equals to the inflation in the home currency times the divided by the inflation in the foreign currency. And of course, because these are percentages, you add 1 to take your analysis. And when all these three are giving the same answer, that is the perfect economic environment, but it does not happen, and therefore comes in arbitrage. What do you mean by arbitrage? Arbitrage means the free ka profit. Mufti. And what is covered interest arbitrage? You are basically creating a replicating portfolio to generate risk-free rate or risk-free return basically. And how do you do it? The conditions for it are same. When the interest rate parity does not hold good. What do you mean by interest rate parity? You get an expected spot rate which is not equal to the forward rate that is quoted in the markets. So either the forward rate could be undervalued or it could be overvalued. If the forward rate is undervalued, you want to buy the forward rate. And if the forward rate is overvalued, you want to short the forward contracts. Understand that when you buy a forward contract, you are contracting to buy the future foreign currency at the future date. In order to buy the future foreign currency, you need INRs. So you need INRs at that date. And how do you get those INRs? You need a deposit in the home currency. And to get those deposit, you need still money to make that deposit. So you borrow in the foreign currency, and the basically what happens is, first get the first principle straight in. When you buy a forward, you are contracting to buy a foreign currency. That is, you have to make a payment in home currency at that date to buy these foreign currencies. And what you are required to do, you are required to do with these foreign currency, what the best thing is to settle a liability. So you need to create a liability as well in the foreign currency. And when you buy these, when you get the liability, you get the cash, you convert it to your home currency and deposit. Okay. So the first step is to create a foreign liability. You create a foreign liability, you take a loan and you convert it to the home currency at spot rate. You get it deposited in the home bank. The home bank earns you an interest of whatever the rate is, and the foreign currency loan costs you an interest in the foreign currency rate. And then at the final date, you break your deposit, you take the money, you use your forward contract, convert it to foreign currency and repay the loan, and you take the net differential receipts, and the net differential receipts should give you the profit or loss. Okay. And when the spot rate, when the forward is overpriced, when the forward is overpriced, you are trying to sell the forward. What do you mean by selling the forward? In the previous, when you buy the forward, you are contracting to buy the dollars. And in selling the forward, someone else would be buying the dollars. You need to deliver the dollars. And when you want to deliver the dollars, you want to have the dollars. You would want to create a deposit in the foreign currency. And to create a deposit, you need the money. So you borrow in INR. First, you borrow from at home bank. The home bank costs you an interest in the home currency. And then you convert that proceeds from the loan at spot rate, you deposit in the foreign bank. The foreign bank earns you an interest. You break that deposit, use the forward contract, deliver the notes, and get INR back and repay the Indian loan. And basically, you create an arbitrage from the proceeds. This is all the solving concepts. Okay, then there is nostro, vostro, and loro account. Okay, so nostro, vostro, loro account, very simple. I don't want to indulge into details. It's your account with us, our account with you, and whatnot. Loro is basically when a bank already has a nostro account and another bank uses the same account for their foreign transaction. That's loro account. Nothing special. To solve the questions, you would have a cash position, you would have an exchange position. There is only one great question on this. Solve it for better understanding. The cash position means that the bank will send you a statement in which you have all the transactions that you have conducted. It would have opening balance, closing balance, and spot transactions. But you would have the exchange position, that is the uncleared reconciliation transaction or the books transactions, as well as the spot transactions. The spot transaction will also need to be entered in the books. So think of it as a bank reconciliation statement. So the bank will only have the spot transactions, but the books will have both the transaction which are yet to be undertaken, outstanding positions, and your spot transaction. So that is the books position. That's how you do it. And then I have discussed some tips and problems that I face. The first one is of course the GBP to dollar. That's the exception rule. I've talked about it. When the spread is negative, you need to deduct it. I sometimes forget about that. Implied swap points means that the difference between the future and spot, it's the same as the basis. Why do they call it swap? I don't know. Okay. Then you have when there is a margin, when there is a margin of 5 paisa or something given, you only add it to the INR quotes and not to the dollar quotes. So if it's a given INR to dollar, you add it to the INR to dollar, but you don't add it to the euro to dollar quote because the margin is in paisas. Okay, and if you are contracting for a hedge of 2 months, you need to use the relevant swap rates of 2 months to get to that point. The contract should be outstanding. That's the basics of finance again. To get to a 2.5 months of the swap rate, what do? You get the 2 month swap rate plus you have the differential between the 3 month swap rate and the 2 month swap rate and divided by 2 to arrive at a 15-day swap rate for at that point of time, and you get the 2.5 month swap rate. This was again a question. To cover the transaction means to hedge. So if a bank has sold dollars in the Japanese market, it needs to cover its position, so it will buy dollars in the Indian market. That's what you mean by covering the transaction. Margins. Margins need to be added to the ask rate and deducted to the bid rate. What do you mean by that? If I want to buy $5, I would have to pay the ask rate. $5 times the ask rate. So if I want to increase the cost, make a commission for the bank, I would add it to the ask rate. Let's say the other way around, I want to sell the $5. What will I get? I would get the bid rate. So how does the bank earn? It will deduct the margin from your bid rate. So that's the concept behind it. Nothing else is left in this chapter, and that's all.